Welcome to this explainer. Today, we are going to literally look under the hood of corporate balance sheets. One wrong accounting move can completely tank a company's valuation, so we're going to follow a company's financial life cycle from the very first shares issued by a scrappy startup all the way to the incredibly complex mergers and acquisitions of a mature public corporation. It is a really fascinating look at exactly how accounting, finance, and law all intersect. Here is our roadmap for today. First, we'll look at structuring the cap table. Second, compensating with equity. Third, hitting the public markets. And finally, expansion and complexity.
All right, let's jump straight into Section 1, structuring the cap table.
At its core, capital structure is where finance, law, and accounting collide. Your capital structure policy is essentially the governing document that outlines a company's target debt-to-equity ratio and its acceptable leverage range. And listen, this isn't just some set-it-and-forget-it document filed away in a drawer. It requires a strict annual review by the board and the CFO. Why? Because how a company balances its debt and equity directly dictates its cost of capital and its overall risk profile. If you get this wrong, a company can over-leverage itself straight into bankruptcy before it even gets off the ground.
So early on, founders and employees usually receive common stock that carries your standard voting rights and a residual claim to the assets. But venture capitalists, well, they demand preferred stock. And that comes with some very powerful contractual rights, like liquidation preferences, which basically ensures they get paid first if the whole company goes under, along with cumulative dividends.
Okay, here is a massive trap you want to avoid. Never ever confuse the legal ceiling of authorized shares with the outstanding shares that you actually use to calculate earnings per share. It's like a giant puzzle. Your authorized shares are the absolute legal maximum the company can issue, and that's locked in the corporate charter. Issued shares include everything you've ever put into circulation. But outstanding shares, that's your issued shares minus any shares the company bought back. That outstanding number is the exact denominator you have to use for market cap and earnings per share. If you hit your authorized limit right in the middle of a vital funding round, you can't just print more shares out of thin air. You are completely paralyzed until you get a formal shareholder vote.
Moving right along to Section 2, compensating with equity. Cash is often super tight for growing companies, right? So they use their stock as this incredibly powerful tool to attract talent. But the accounting rules for this under ASC 718 follow a really rigid timeline. For stock options, the fair value is locked in stone on the grant date, and they often rely on the infamous Black-Scholes model to weigh the stock price against expected volatility. Once that value is locked, that expense is stubbornly recognized over the entire vesting period, which is simply the time the employee actually has to work to earn those shares.
Now, your vesting schedule completely dictates your accounting. If an employee gets cliff vesting, say 100% of it vests after exactly 4 years, the expense is recorded in a nice, simple straight line. But grade investing, where a portion vests every single year, that is a totally different beast. US GAAP actually requires you to treat each vesting interval, or tranche, as a completely separate award. This creates a massive, front-loaded compensation expense in year one that can absolutely crush a startup's early earnings reports if they aren't expecting it. And hey, watch out for employee stock purchase plans, or ESPPs, which let workers buy stock at a discount. There is a huge bright line rule here, 5%. If the discount you're offering is 5% or less, it's considered non-compensatory. No expense recorded, you're good. But if you offer a discount greater than 5%, or if the plan has a look-back feature, it immediately triggers compensatory expense recognition across the entire offering period.
Okay, Section 3, the public markets.
Going public entirely transforms a company's obligations. A traditional IPO is a rigorous, grueling, multi-step process. First, you have to file the massive S-1 registration statement with the SEC. After they finally clear it, management goes on a roadshow to build an order book from institutional investors. Then comes pricing. But here's what always surprises people. When the stock finally lists and starts ringing the bell on the exchange, the company doesn't actually have the cash yet. The cash is only finally received at the closing, which is typically 3 business days later. And it arrives net of the 5 to 7% underwriting discount paid straight to the investment banks. Once you're public, a company with excess cash might decide to buy back its own shares to hold as treasury stock. But they can't just go out and buy an unlimited amount to artificially pump up the stock price. SEC Rule 10b-18 acts as a strict safe harbor. It protects the company from market manipulation claims by safely limiting the daily buyback volume to no more than 25% of the stock's average daily trading volume.
Being public means you basically live and die by earnings per share, or EPS. And there is a major bear trap hidden right here, forgetting to subtract cumulative preferred dividends from the earnings per share numerator. It is a classic high-risk pitfall that trips up so many controllers. Listen, even if the board of directors never actually declared a dime of dividends this year, if the preferred stock is designated as cumulative, those unpaid dividends just keep accumulating, and they absolutely must be subtracted from net income before you calculate the earnings available to common shareholders. Finally, we reach Section 4, Expansion and Complexity. When our newly mature company starts buying stakes in other businesses, the accounting shifts entirely based on your level of influence. Below 20%, you're just a passive investor using the fair value method. Easy enough. Hit that 20 to 50% sweet spot, and you presume significant influence, so you switch to the equity method to recognize your proportionate share of their income. But once you cross that 50% threshold, you now have control, my friend, and you must consolidate 100% of that entity's assets, liabilities, revenues, and expenses directly onto your own books.
But here is a really fascinating twist. Under U.S. GAAP, power isn't always just about voting shares. Sometimes companies engineer these incredibly complex legal structures where voting rights are completely detached from economic reality. Welcome to the Variable Interest Entity, or VIE. It's a structure historically famous for keeping debt off the balance sheet. If a target hits any of these indicators, like having insufficient equity to finance its own operations, or the equity holders lacking actual decision-making power, or maybe the equity holders are entirely insulated from losses, standard voting rules are just thrown right out the window. To prevent accounting tricks, the primary beneficiary, which is the party who holds both the power to direct activities and the economic exposure, they must consolidate the VIE, regardless of their actual ownership percentage. When our company outright buys another business, we use the acquisition method under ASC 805. You have to measure the consideration transferred, which includes all the cash paid, the fair value of any equity issued, and any contingent earnouts. Then you measure the fair value of the net identifiable assets you actually acquired, like property, tech, and customer relationships. The excess of the consideration transferred over the fair value of those net assets is recorded as goodwill. And here is a crucial rule for public companies. Goodwill is never, ever amortized. It is only tested annually for impairment. To fund all this massive expansion, companies often issue convertible notes, right? That's debt that can eventually be converted into shares. In the past, accountants had to painfully bifurcate, split this into separate debt and equity components. It was a headache. But thankfully, under the new ASU 2020-06 rules, we skip the split. The entire note is just recorded as a single liability unit of account at amortized cost. This dramatically simplifies the balance sheet and actually reduces the reported non-cash interest expense. Well, we've covered a tremendous amount of ground today, from initial startup capitalization all the way through to consolidating variable interest entities. But the accounting landscape, it's never static. With rules constantly evolving, just look at the SEC's massive SPAC warrant reclassification that forced hundreds of companies to restate their earnings. The ground is quite literally always shifting, so it leaves us with one big question. What shifting standard will redefine your balance sheet next? Thanks so much for joining me on this explainer.